If you own a home, pay close attention because this is something many people completely overlook until it becomes a serious financial problem. There are tax rules connected to homeownership that can trigger massive penalties, and in some situations, those penalties can grow into tens of thousands of dollars. Today, we are talking about a shocking issue connected to IRS reporting requirements, property-related taxes, and financial mistakes that homeowners sometimes make without even realizing the risk involved. Some people think owning a home only means paying a mortgage, insurance, utilities, and property taxes. But there are many financial and tax responsibilities tied to homeownership that can create problems if ignored. One of the biggest misunderstandings homeowners have is assuming that if they are not running a business from their home, or if they are not wealthy investors, they are automatically safe from major IRS penalties. That is not always true. There are situations involving unreported income, incorrect deductions, foreign transactions, rental activity, home office misuse, inherited property issues, and capital gains reporting mistakes that can lead to very serious consequences. In some cases, penalties and interest continue to grow for years before the homeowner even understands what happened. Many people also fail to realize how aggressively penalties can increase once the IRS determines there has been negligence, substantial understatement of income, or intentional failure to report taxable events. What starts as a simple filing issue can eventually become a very large financial burden. The reason this topic is important is because most homeowners believe these penalties only affect wealthy individuals or people committing obvious fraud. In reality, regular homeowners can face major problems simply because they misunderstood the rules or failed to report something correctly. One of the most common areas of confusion involves capital gains taxes when selling a home. Many homeowners believe that profits from selling a primary residence are always completely tax-free. While there are important exclusions available under tax law, those exclusions have limits and conditions. If a homeowner exceeds the exclusion threshold or fails to meet residency requirements, a portion of the gain may become taxable. If that taxable amount is not properly reported, penalties can apply. For example, homeowners who sell a property after large increases in value may assume the entire gain is automatically excluded. However, tax law has specific limits regarding how much profit can be excluded from taxation. If the IRS later determines that part of the gain should have been reported, the homeowner may face back taxes, penalties, and interest. Over time, these costs can grow dramatically. Another major issue involves rental income. Many homeowners rent out part of their property or temporarily rent their home through short-term rental platforms. Some people mistakenly believe occasional rental income does not need to be reported. That assumption can create serious tax problems. Rental income is generally taxable, and failing to report it accurately may trigger penalties. In some cases, homeowners also incorrectly deduct expenses related to rental activities, leading to additional IRS scrutiny. Short-term rentals have become especially important in recent years because more people are using online platforms to generate income from their homes. The IRS receives increasing amounts of information from payment processors and rental platforms. This means homeowners who fail to report income may eventually receive notices questioning discrepancies between reported income and third-party records. Another issue that can create huge penalties involves the home office deduction. Many taxpayers hear about home office tax benefits and assume they qualify automatically. However, the IRS has strict rules regarding business use of a home. The space must generally be used regularly and exclusively for qualifying business activities. Some homeowners claim deductions improperly, either by misunderstanding the rules or exaggerating business use. If the IRS audits these deductions and finds significant errors, penalties may apply in addition to back taxes. Mortgage interest deductions also create confusion. While mortgage interest can provide valuable tax benefits, there are limits and documentation requirements involved. Some homeowners mistakenly claim deductions they are not eligible for, especially when dealing with second homes, refinancing, or mixed personal and business use of a property. Incorrect deductions may increase the risk of audits and financial penalties. Inheritance and gifted property issues are another area where homeowners encounter unexpected tax problems. When someone inherits property, the tax basis rules can become complicated. Many people later sell inherited homes without fully understanding how the adjusted value should be calculated. Reporting the wrong basis can significantly change the taxable gain amount. If the IRS determines the gain was understated, additional taxes and penalties may follow. Foreign property transactions can also trigger severe penalties. Some homeowners maintain overseas bank accounts connected to property ownership abroad or receive rental income from foreign real estate. There are strict reporting requirements related to foreign financial accounts and international transactions. Failure to disclose required information can result in extremely large penalties, sometimes far beyond what people expect. Many taxpayers are completely unaware of these obligations until they receive notices from tax authorities. Property tax deductions are another area where mistakes happen frequently. Homeowners sometimes confuse deductible and non-deductible expenses or incorrectly claim amounts that exceed legal limits. Changes in tax laws over the years have modified deduction caps and eligibility requirements. Taxpayers relying on outdated information may unintentionally file incorrect returns. One of the biggest reasons these problems become so expensive is interest accumulation. IRS interest compounds over time, meaning unpaid balances continue growing. A homeowner who ignores notices or fails to address issues promptly may see a manageable problem become overwhelming after several years. Penalties for late filing, late payment, negligence, and substantial understatement can combine together, creating extremely large balances. Another important issue involves inaccurate reporting during refinancing or debt forgiveness situations. Some homeowners restructure loans, receive mortgage modifications, or experience debt cancellation. Depending on the circumstances, forgiven debt may be treated as taxable income unless specific exclusions apply. Many people do not realize that canceled debt can create tax obligations. If it is not reported correctly, the IRS may later assess taxes and penalties. Real estate investors who own multiple homes face additional complexity. Tracking depreciation, rental expenses, maintenance costs, improvements, and property sales requires detailed records. Poor record keeping can create major issues during audits. The IRS expects documentation supporting deductions and reported figures. Without proper records, taxpayers may struggle to defend their filings. Homeowners who flip properties also face special tax considerations. Some individuals buy homes, renovate them, and sell them quickly for profit. Depending on how these activities are classified, profits may be treated differently for tax purposes. Some taxpayers mistakenly report these transactions as capital gains, when they may actually qualify as ordinary business income. Misclassification can lead to substantial tax differences and potential penalties. Energy efficiency tax credits have also created confusion. Homeowners often hear about credits for solar panels, energy-efficient windows, insulation, and other upgrades. While these credits can reduce tax liability, they require accurate documentation and compliance with specific rules. Claiming ineligible improvements or overstating expenses can trigger IRS challenges. Another growing concern involves identity theft and fraudulent filings connected to property records. Criminals sometimes use stolen identities to file fraudulent tax returns or manipulate property-related financial information. Homeowners who do not regularly monitor tax documents and IRS correspondence may fail to notice problems until significant damage has occurred. Estate planning mistakes can create tax complications for families inheriting homes. Some individuals transfer property ownership improperly or fail to understand gift tax implications. Others add family members to deeds without realizing the potential tax consequences later. These decisions can affect future capital gains calculations and create unexpected financial liabilities. One reason homeowners become vulnerable to penalties is that tax rules change over time. What may have been accurate years ago may no longer apply today. Many people continue relying on outdated advice from friends, relatives, or old internet articles. Tax laws involving deductions, exclusions, and reporting requirements evolve regularly, making updated information extremely important. Documentation is critical in all property-related tax matters. Homeowners should maintain records related to purchase prices, renovation expenses, refinancing documents, property taxes, insurance, rental income, and improvement costs. These records help establish accurate tax reporting and protect taxpayers during audits or disputes. Another major issue is failing to respond to IRS notices quickly. Some homeowners ignore letters because they assume the issue is minor or because they feel overwhelmed. Ignoring notices usually makes the situation worse. The IRS may continue assessing penalties and interest while enforcement actions escalate. Responding early often creates more options for resolving disputes or arranging payment solutions. Payment plans are available in some situations, but taxpayers must still address the underlying issues properly. Some homeowners mistakenly believe that setting up a payment arrangement automatically resolves all concerns. However, filing accuracy and compliance remain essential, even when payment plans are approved. Professional guidance becomes especially important when dealing with complex property transactions. Tax professionals can help homeowners understand reporting obligations, identify eligible deductions, and avoid common mistakes. While some taxpayers prefer handling taxes independently, real estate transactions often involve technical rules that require careful attention. Homeowners should also be cautious about aggressive tax strategies promoted online or through advertisements. Some schemes promise large deductions or secret loopholes related to homeownership. Many of these strategies are risky or misleading. Following improper advice can expose taxpayers to audits and severe penalties. Retirees face unique considerations regarding home sales and tax planning. Some retirees downsize, relocate, or sell long-owned homes with significant appreciation. Understanding how exclusions work and how gains are calculated is essential for avoiding surprises. Retirees may also need to consider state taxes, inheritance planning, and healthcare-related financial implications. Divorce can create additional complications involving property ownership and taxes. Transfers of property between spouses, sale proceeds, mortgage responsibility, and capital gains treatment may all affect tax obligations. Failure to handle these issues properly during divorce settlements can lead to future disputes and unexpected liabilities. Disaster-related property losses may qualify for deductions or special tax treatment in certain cases, but these rules are specific and require documentation. Homeowners affected by natural disasters should carefully review available relief provisions rather than assuming all losses are automatically deductible. Another overlooked area involves improvements versus repairs. The IRS distinguishes between property improvements that add long-term value and repairs that maintain existing condition. This distinction affects how expenses are treated for tax purposes, especially in rental properties. Misclassifying these costs can create reporting errors. Property ownership through trusts or business entities adds another layer of complexity. Some homeowners place properties into trust for estate planning purposes, while others use limited liability companies for rental properties. Each structure has different reporting obligations and legal considerations. Mistakes in these arrangements can create compliance issues. The reason penalties can become so large is because multiple issues often occur simultaneously. A homeowner may have underreported income, incorrect deductions, unpaid taxes, and accumulated interest all combined together. Over several years, the total balance can become extremely high. This is why proactive tax management matters so much. Technology has also increased IRS enforcement capabilities. Digital reporting systems, automated matching programs, and third-party information sharing allow tax authorities to identify discrepancies more efficiently than ever before. Mortgage records, property sales, payment processor reports, and banking information are increasingly connected through reporting systems. Another important topic is estimated taxes for homeowners with rental or self-employment income. Some taxpayers owe quarterly estimated payments but fail to submit them properly. Underpayment penalties can apply even if the taxpayer eventually pays the balance during annual filing season. Property owners should also understand the difference between federal and state tax obligations. State tax agencies may have separate rules regarding deductions, reporting, and penalties. A taxpayer compliant at the federal level could still face issues at the state level if local requirements are ignored. Home equity loans and lines of credit involve their own tax considerations. Interest deductibility depends on how the borrowed funds are used. Some homeowners incorrectly assume all home equity interest is deductible, which may not always be true under current law. Another issue involves casualty insurance settlements. Insurance payouts for property damage can create tax implications depending on how funds are used and whether gains result from settlements. Some taxpayers overlook these reporting obligations entirely. Homeowners who inherit or co-own property with relatives often face disputes about taxes, maintenance expenses, and eventual sales. Poor communication and lack of documentation can complicate reporting responsibilities and increase financial risks. One major lesson from all of these situations is that homeownership carries financial responsibilities beyond monthly mortgage payments. Tax compliance, record keeping, and accurate reporting are essential parts of protecting long-term financial stability. The fear surrounding large IRS penalties often comes from misunderstanding and lack of preparation. Many problems could be reduced or avoided entirely through better awareness, timely filing, and proper documentation. Staying informed about tax rules and seeking professional guidance when necessary can significantly reduce risks. Another critical point is that IRS penalties are not always immediate. Some issues remain unnoticed for years before audits or automated reviews identify discrepancies. By that time, accumulated interest and penalties may dramatically increase the amount owed. This delay often shocks homeowners who believed everything was handled correctly. Communication is extremely important during any tax dispute. Responding promptly, providing requested documents, and understanding available resolution options can make a major difference in outcomes. Panic and avoidance usually create more stress and financial damage. Many homeowners underestimate how detailed real estate tax rules can be. Selling a home, renting part of a property, refinancing loans, transferring ownership, and claiming deductions all involve separate regulations. Even honest mistakes can have serious consequences if large amounts of money are involved. Financial literacy plays a major role in preventing these problems. Understanding the basics of taxes, deductions, reporting obligations, and documentation requirements empowers homeowners to make better decisions. People do not need to become tax experts, but they should understand the major rules affecting their property. The idea that the IRS doesn't want you to know about penalties often reflects the reality that many taxpayers simply never hear about these issues until something goes wrong. Tax laws are public, but they are also complex and difficult for many people to understand fully. This complexity creates situations where homeowners unknowingly make costly mistakes. Ultimately, the most important thing homeowners can do is remain proactive. Keep organized records, review tax filings carefully, verify eligibility for deductions and credits, report all required income, and seek professional advice when situations become complicated. Preventing problems is almost always easier and less expensive than fixing them later. Homeownership remains one of the biggest financial commitments many people will ever make. Protecting that investment requires attention not only to mortgages and maintenance, but also to tax compliance and financial planning. Large penalties rarely happen because of a single small mistake alone. They usually result from a combination of misunderstanding, poor documentation, delayed action, and lack of awareness over time. The good news is that most homeowners can significantly reduce their risks by staying informed and organized. Understanding how taxes relate to property ownership is a powerful step toward financial stability. When homeowners take the time to understand their obligations and keep accurate records, they place themselves in a much stronger position to avoid unnecessary penalties and financial stress in the future.